First off, welcome everyone to the webinar. I hope you had a wonderful weekend and good start to your week so far. Tonight we'll be talking about long-term investment strategies. As we all know, trading does carry a high level of risk, and you're subject to lose all or more of your original investment, so don't trade with money that you can't afford to lose, or money that, if lost, would affect your current lifestyle. The information in this presentation is for educational purposes only and is not intended to be financial advice. And additionally, I am not a financial advisor or any sort of licensed accountant. So the purpose of this webinar is to help you better understand the markets and improve your skills as a trader. I believe that a balanced life leads to a healthy life, and our attitudes influence our behavior. Trading is a small but meaningful part of the bigger picture. So today I'd like to touch upon some of that bigger picture and how you can apply some of the trading strategies to the bigger picture for a little bit longer term investing, or at least give you some things to think about in terms of, longer term down the road, even farther out than the next 5 years, looking in terms of building a larger plan, building a 20 or a 30-year plan. I know we have folks in the room, everyone ranging from early 20s to retirees, both traders who trade full-time and traders who trade part-time. So we'll try to address some examples for a lot of the stuff that we'll talk about, and we'll try not to digress too much. I do have a lot of good stuff that I want to get to tonight. So to start off with a little outline, first want to talk about how to get started, kind of where the jumping off point would be. We'll talk about some investments that you may want to consider. And I know some of these things may be investments or things that you're already implementing, and others may be new. So hopefully I give you some good ideas or spark some ideas for you. We'll talk about creating your own retirement plan because, as you know, being a trader, running your own business, you may not have any sort of 401k plan already in place. So we'll talk about how you can kind of create your own. We'll also talk about some of the benefits of working and trading part-time. We'll talk about how to structure your portfolio, or at least I'll give you some ideas from my own portfolio. Talk a little bit about value-based trading. There's a couple things that I found rather interesting that I wanted to share. As I mentioned, some traders opt to trade part-time and work part-time, and there can be some really good benefits to that. So we'll touch upon those. And then lastly, we'll kind of wrap things up with talking a little bit about real estate and why a lot of traders do really well in the real estate market. And, especially in the times that we're in right now, there's some great opportunities, and it's always good to, when you hear advisors and things talking about diversification, it doesn't just mean within your stock portfolio. There's some other things that we can do as well. So give you some ideas there. And I know there's a couple of, I think Mike from Arizona, I was talking to a little bit, is pretty big in the real estate side of things. So it's really interesting. I don't know if you guys have ever had the chance to talk to some real estate investors, and whether or not they trade. Just talking to real estate investors is a really good conversation, and I always tend to find similarities between real estate and trading. So we'll kind of close, bringing it back to a little bit on real estate. But let's first talk about how to get started, and really, what's your long-term goal here. And I think for a lot of us, the long-term goal is, that cash flow, that passive income, and really building that asset base that we can live off, living off, the interest. That's really the end goal for a lot of us. And building that capital, building that that net worth and those assets is really where we need to first begin. So day trading in itself is used to generate income, and it's a fantastic vehicle to then fund those longer term investments. And it's really a way to leverage your current assets, especially in the day trading of the futures markets, leveraging your current assets, your current capital, to fund those long-term investments and the other projects and things that you want to things that you want to obtain and different ventures that you want to achieve. Day trading is a great way to kind of settle on your own terms and make your own living. So one of the best things is the concept of compounding interest, which I'm sure you all know, but I really wanted to just touch on a couple quick things, and using the Money Chimp calculator that I'll pull up here. Let's see. Okay, I think we're still good. I don't know if anyone's noticed that the new update of Firefox has been crashing a little more than the past versions. I'm not too pleased with that, but so just some simple things to think about when you're getting started. I know that a lot of the traders that I chat with do happen to be really young, and if you're one of them, it can be intimidating to think about 20 years, 30, 40, 50 years down the road. But it's important not to let that intimidation kind of inhibit or prevent you from getting started. So, let's say we'll do a couple examples here just really quickly. So let's say you're fresh out of college, and you have some student loan debt, and you may have, we'll just say, $5,000 saved up. And you get out of college and you either begin trading with some of your own capital, which in most cases for the person fresh out of college isn't always the best route. So let's say you sign on with a trading firm, a prop firm, and you work out the the typical either 60-40 split or 70-30 split, and start bringing in a little bit of income, learning how to trade, going through the mentoring process, and you're able to save, we'll just say $100 a week. You can set that aside, and so by just throwing in $5,200 a year, and let's say you're 25 years old and you give it 25 years to grow, the stock market over the past 80 or 90 years, at least that we have data for, has averaged 6% after inflation. So we'll just throw 6% in there, and so just throwing $100 a week aside, well over $250,000 in a 25-year time frame. So it's just one of those things where those little contributions can really build into something great. Now let's say you've worked in IT for 10, 15 years. I'm 40 years old, and I've got $100,000 in the bank. Got some 401k and some savings and things like that. Maybe I have my own home almost paid off, and I can afford as well to put $100 away a week. And we'll say I'm 40 years old, so by 60 I'd like to have a really good chunk of change. And again, using that 6%, by throwing $100 a week into the market, and we'll talk about where that money can go, you're looking at $500,000. And if you can add, we'll say, $200 a week, and you're 30 or 40 years old, so you have 20 or 30 years that you have time that you'd like your money to grow before you start pulling from it at the 6%, $750,000. So I guess just quickly the example that I'm trying to convey is, starting small is where everyone will most likely begin, unless you're inheriting some sort of windfall. But by weekly contributions, you can really begin to build a very large portfolio. And in the same way that with trading, those singles and doubles that we take every day, maybe we take 2 points here, 3 points there, maybe we have a couple bigger winners for 4, 5, 6 points, but focusing on not going for that home run of 15 points, 20 points, 100 pips every day, rather taking those smaller winners, taking those singles and doubles will compound over time. So the Money Chimp is what I was using for this little calculator, but let's move back over to the slides. And so compounding interest, it helps you when it's in your favor. It hurts you when it's in your debt. So something to certainly keep in mind. So how to get started. And one of the most important things that I mentioned earlier that I want to stress is don't be fooled by those small steps. Sometimes when something's so easy, it's just so easy not to do. So if you're just starting out, and I know this pertains to some of the younger folks, but whatever age you are, those small steps, you just take that first step, and that's usually the hardest part for any venture, is taking that first step. So if you're just starting out, those weekly deposits that I mentioned into a savings account, you can use discoverbank.com or your credit union. Those usually have, in most cases, the better interest rate. But really, you're not concerned with the interest rate at this point. This is simply a way to, pay yourself first, to build that portfolio of, build that cash base that you can then put towards your portfolio. It's great to say, yeah, this next paycheck, or, for those that are still working or that are maybe working part-time and making the transition over to trading full-time, it's nice to say, yeah, the next $5,000 or $10,000 that I get, I'm just going to put aside. But how often does that happen? Very rarely. So those little contributions along the way are really helpful. Yeah, and Sean mentions, being okay with winners that are 2 to 1, even 3 to 1, not going for that home run as I was, talking about earlier, and just being able to take consistently, taking those little bit smaller profits and walking away ahead. So I'm going to be doing a little bit more on expectancy coming up, and we can talk more about, developing that expectancy curve a little bit. So I won't go into too much of that right now. But whether you're young or old, one of the great systems that we have in place, the Roth IRA, that tax-free growth, and it's more versatile than people think. There's a lot of things that you can do inside an IRA. You can use it to buy real estate. You can use it to trade. You can buy and sell options within your IRA. And the best part is that it is tax-free growth. The traditional IRA, then, one of the advantages there is that it can lessen your tax bill now. And this is really good for the higher income earners. So you can deduct the contribution to a traditional IRA this year, and then the growth that is received on that account is then taxed in later years. So if you have a really high income at this point, you can use that to lower your current income tax bill. So the IRA is super helpful for those with high income. There are caps on both Roth and the traditional, but two tools that are more versatile than a lot of people realize. So some investments to consider before we get into a couple specific strategies and techniques that you can use. Obviously, mutual funds, ETFs, dividend-paying stocks and bonds. But then also, gold and commodities, looking at those as an inflation hedge, not so much in terms of, trading them, buying and selling gold on an intraday basis, but more on a longer term hedge for inflation. And then we'll talk a little bit more about real estate. And then one other one that some people are surprised with sometimes is artwork and collections. And these can be, especially artwork, things like paintings, things that have, the artist has passed on, and these kinds of things will, hold their value relative to inflation. So these are other investments that, can be a good place to park money from time to time. Yeah, diamonds, Sean. At the actual physical gold as well, not just the commodity. Hoarding barrels of gold of oil may not be the best strategy, but certainly the physical commodity of gold is of value. And so, let's talk a little bit about creating your own retirement plan. And I think it's really important to just sit down and start by identifying all of your current expenses and find out, if there's areas that you can cut back on, if there's areas that, things that are being wasted, and then find out what you can eliminate. Because when you can determine your yearly expenses, then you can set some sort of dollar goal that you're looking for achieving. And one of the kind of standard longer term outlooks is that by withdrawing 4% a year on an account balance, 4% is kind of the dollar amount or the percentage amount that will withstand the market ups and downs. So if you can determine your yearly expenses and then take that number and multiply it out, you can then determine what the dollar amount would be needed. You can use that same MoneyChimp calculator on the side there. You can put in your expenses and then find out what dollar amount. And so some people are a little bit intimidated again about needing these millions of dollars to sustain your lifestyle. But if you really do the numbers, a lot of times it doesn't take $5 or $10 million to live off of the interest and off of the investment income that provides. So, find out what you can eliminate in cutting down on the waste. Really good blog that I like to read is from Mr. Money Mustache, kind of a, I would say, a little bit lifestyle design, looking at ways to be efficient, looking at things, alternative ways to, eliminate some expenses and alternative ways to, achieve a lot of the same goals that other people have. And so he's got some really good articles in there, everything from, financial articles and talking about, ways to retire early, and everything to, auto, home, friends and family. It's an interesting blog, and I recommend checking out some of those articles over there. Mixing the brokerage and IRA account is what I have set up, and through Thinkorswim, TD Ameritrade, and I'll go through the breakdown in a minute here. But some of the funds to consider if you're looking to kind of build and manage your own portfolio as opposed to have an advisor do it for you. Advisors are great, and there's a lot of things that they can do and that they can provide for the average citizen. But if a lot of the traders in the trading minds are those who want to manage their own finances, and so some of the funds to consider would be the Vanguard funds because of the low expenses that are taken out. So VGSTX, Great Asset Allocation Fund, VWESX is a bond fund, and then some other funds or some other ETFs to look at would be the Dow and the S&P, and the SDY and DVY are the dividend, larger dividend paying version of that, and then the NASDAQ and the Russell QQQs and the IWM. And so this way you will own the market, and you'll be collecting dividends at the same time. You hear a lot about how the lost decade and the lost years in the stock market, but by collecting dividends and things, it's not necessarily a lost decade for the investors. Maybe for the index itself, I use air quotes around the lost decade, but it's not lost by any means for the little bit savvy investor. So then structuring that simple portfolio, at least in the stock and investment portion, the way I have just the basic things set up, or the way to kind of go about for those that are just starting, that are looking to build that base, build that foundation to then contribute to, allow it to grow, and then break out pieces of that and to do your own diversification. I do like the Vanguard, that VGSTX, that's the asset allocation fund. And then in the Roth IRA, I break that down into the bond fund. And that's dividend, both dividend paying. And then I also use a portion of the broader market, those ETFs, so that I'm owning the market. I'm owning essentially, in some ways or another, an inverse value to the market, owning the bonds, and then the the asset allocation as well. And then so you begin to put all this together, and then you can look at what portion of your trading account are you utilizing for day and swing trading. And I would say no more than 25% of your net worth, or at least your asset base, used for swing trading and day trading in general, because there's a lot of psychological emotions that come into play, as you know, and a lot of those pressures can be removed if you kind of dial back your trading account size and build up the longer term portfolio at the same time. So using your trading account for day and swing trading, again, builds that foundation, or it's nice to have that foundation of the little bit longer term investments as well. And then that reduces the psychological pressure and allows you to trade more effectively. And it builds a little bit security into it too, knowing that obviously we use stops, we manage our risk, but our worst case scenario is a 25% drawdown of our entire net worth, and that's something that you can certainly come back from. So all of this is kind of built around managing risk, and I'm a little bit more conservative than some of my trading colleagues out there, some of my friends that we both trade very similar styles, but I'm a little bit more on the conservative side. So that's why I do lean a little bit towards building up a little bit more of that longer term outlook, and then diminishing the actual percentage of the trading account itself. So some rules for building those long. If you're going to be building a position that's a little bit longer term, there's a couple things that you can do. Super simple, and as the entries and things are not as important as you would think. Now, it will probably make sense that the smaller the time frame, the more important the entry. If you're entering on a 3 or 5 minute chart and you're looking to take 2 points, well, you kind of need to be precise down to the tick. If you're entering on a daily chart, you don't need to get down to the penny itself, but there's a couple things that I do look for. Obviously, buying when the market is low is something that I'll get into a little bit more on, which seems simple, but there's a couple things that I want to touch on as well. When we're in a downtrend and that downtrend breaks, when it breaks that swing high and we put in that higher low, that is when I like to add to a longer term position. And then buying that first up day after we've had at least 2 days of a pullback. So me pull up a little chart here. So this is a daily chart, and so we've had this downtrend back in May and June, and once we broke the swing high, we put in that higher low. That's my signal to then add to the position. So you would say, oh well, why don't you put the whole position on when we're at lows? Well, the concept here is you're adding over time. You're building up that that cash base, that asset base. And so, 1 month you establish an initial position, and then you wait for that next opportunity when everyone is scared or thinking that we're so far off highs, the market is on its way down, or you're in trouble. You identify that, okay, we've broke that prior swing high up here, and we put in that first higher low. That's a great opportunity to add to a longer term position that you're looking at over the course of a daily chart or a weekly chart. And then I mentioned that 2-day pullback. If you look at just a regular candlestick chart in any mutual fund, there's going to be no intraday data, so the chart would look like this. And so you can just count the pullback little bars, and once you pull back, at least, this is the same chart, just the line version. When we pull back at least 2 days, that's when I like to add to the position. So we were trending down, broke the prior swing high up here. This one was taken out. Get that first higher low. A lot of the same concepts that we talk about in identifying the trend on the smaller time frames. It works the exact same way in the longer time frames. Just waiting for that pullback and then buying on the first up day after that pullback occurs. So some other things to think about with structuring your portfolio, and this is the kind of how I view the full-time trader's cash flow, if you will. So the way I kind of have it set up is that the income comes from day and swing trading, and at the end of each week or each month, you withdraw some money from your trading account, and you use that money for the weekly deposits that go into your savings account, your brokerage account, your IRA account, and those assets are then building up. And once you've picked the few funds that you're going to be using, whether you're using ETFs or mutual funds or I would definitely caution on trying to build an entire portfolio out of stocks, because with dollar amounts under 100,000, even under 250,000, it's hard to spread all that out, and then at the same time you're going to be eaten up by all the commissions from buying those stocks individually. You want to be able to have 1 or 2 funds that when you get an entry signal, when you get those few months where we've pulled back, the market's putting in some lows, and then we start to turn around, we establish the trend is now moving higher, you want to be able to put on one position or 1 or 2 positions, add to that position, and not be worried about adding to 50 different stocks. So that's one of the reasons where using a little bit conservative route of a mutual fund or an ETF kind of saves you a lot of trouble, or a lot of hassle rather, and saves you fees in the commissions in that regard. So using that money from your trading account to fund your longer term accounts, and then you can invest in those few funds that we mentioned. Obviously you don't have to use Vanguard, that's just what I use. And then reinvest the dividend interest. Then once the savings builds up, or you have a few big months of trading, a few big months that things are going exceptionally well, you can use that money to fund additional investments. And all of this is building that net worth, building that asset base, while your trading account is kind of that that income vehicle. So whether you're day or swing trading, that's kind of how I view just the trading in general. And then if you continue to spend responsibly and not be wasteful, ideally that gap or that margin between your expenses and your net worth, your income will begin to grow and grow and grow. And the more time that goes by, the more compounding that will occur, and the more dividends that get reinvested, and the more weekly contributions and auto deposits will be invested. That's one of the things. Those auto deposits are the single most effective way that Americans, at least, are used to build their net worth down the road. An auto deposit, if you think about 401ks and things like that, that's really the only way that your average American saves for retirement. So being traders, being a little bit more prone to managing our finances and being aware of these kinds of things, you can really get the jump, and in a 5 or 10-year period really make sizable gains to your net worth, all from that trader's mindset, that day and swing trading philosophy, just kind of extrapolated out, keeping things simple and staying consistent. Next, we'll talk a little bit about value-based trading. One thing that is a little bit interesting is if you look at the PE ratio, that's the market price per share divided by the earnings per share, not on individual stocks, but on the S&P 500 and all the stocks that are involved in the S&P 500. The average over all of the years that we have data is 16.4, and we're currently at 16.25. So we're currently right about sitting at the average. And you can take a look at when are stocks on sale, or ask yourself, when is the stock market on sale in general? When is the stock market overbought versus a good buying opportunity? And this kind of number, this 16.4, is a really good barometer. So I don't do much fundamental trading myself, but I do kind of keep in mind this number. And if you look right now, the market is really about average, the average price per earnings. The market is valued at kind of that baseline. So, and this goes all the way back through the late 1880s, the late 18th century. So there's something to be said for taking a look at that 16.4. And if we're down in the S&P, PE ratio is down in the 10, 11, 12 range, that's a great opportunity to be adding to longer term positions, looking at the little bit longer term swing trading. Those kind of markets make for great opportunities because the market is essentially, stocks are quote unquote on sale. So with value-based trading, really in general terms, we're just looking at when the stock market is below that 16.4 that the stocks are on sale. And but remember that just because an individual stock may have a high PE, a Google or an Apple, may have a 20 or 30 PE, some stocks even higher, they can always go higher. And in the same token, just because a stock with a low PE exists doesn't mean that its price is guaranteed to go up. So I just kind of look at the S&P 500 in the broader sense, not the individual price per earnings. And there's so many factors that go into it as well that I won't really get into. But with the financial estimates of a company, there's a lot of variables per individual stock. And Investor's Business Daily is a really good place to kind of get a grasp on some of the longer term concepts, looking at the longer term trend trading, the CAN-SLIM methodology, as I'm sure some of you are familiar with, that kind of deals with the longer term trend trading approach. but also adds a little bit of technical aspect as well. For those that are working and trading part-time, there's some really probably clear benefits that you would see. Obviously, the multiple income sources is great. I myself made the transition from working to trading full-time fairly slowly. I made it a transition. I didn't, stop cold turkey, kind of transitioned a little bit slowly, and I think that helped to not only build the confidence, but kind of get the ball rolling and get in that groove a little bit easier, having less stress at first, not forcing myself to have to pay the bills out of the trading account right away. I could focus on trading effectively, and kind of transition slowly. So having multiple income sources, even while trading, is certainly, if you look at any investor, chances are they don't have all of their eggs in one basket. So the 401k, having that employee matching, that free money is really great if you can swing some sort of part-time deal. Sometimes, I know I talk to a lot of traders who are on the West Coast, and with the time zone out there, or even being in some other countries like Germany or Singapore, you're able to work and trade, and it can make for much lower stress, a much lower stress environment. So, getting that benefits package and those things that we talked about, that when you run your own business, you need to provide for yourself. So that just lessens the financial and psychological pressure a little bit. And it can also allow you to trade more effectively, because instead of sitting in front of the trading screen for 16, 20 hours a day, you really begin to pinpoint and clarify, okay, this is the 4-hour window that I'm going to trade, and I'm only going to trade these markets, and I'm going to focus on trading effectively, looking for my setup within this 4-hour window, and it can really help keep your focus. And then, work doesn't have to be painful or stressful. I know a lot of people who have jobs, so to speak, things that they enjoy doing, and it gets them out from behind the trading screen, and allows the brain to kind of think about other things, but still internalizing the trading thoughts and reflecting on your trades in different environments can be really effective. And you can come up with you can put a lot of the pieces of the puzzle together when you kind of get out of your element and kind of get out of your comfort zone. And then lastly, I want to talk a little bit about real estate, and why traders do so well in real estate, and typically vice versa. And it all comes down to that similar mindset. Both traders and real estate investors were looking to take calculated risks, and we're looking for that risk to reward ratio, looking for those numbers to make sense, looking at undervalued assets, looking for kind of diamonds in the rough, very good at doing due diligence, becoming familiar with a market, an area, and focusing on one strategy, whether you're going to kind of master the rental market, the single-family home rental market for one specific county or one area that you live in, whether you're going to, and that would be kind of the route that I would certainly lean towards versus the fix and flip. And I think kind of getting away from that mindset of making a quick buck really helps take those investments and takes that young trader and turns them into a very successful investor. So a real estate business can be great, and it can be great because you can use it to leverage your capital. Borrowing against homes that you own, taking out, or having access to lines of credit is something that really, real estate is one of the only investments that can provide that. It's, non-existent to, I shouldn't say non-existent, but if you go to the bank and try to take out a line of credit against your brokerage account, I'm betting that they're going to say no. So you leverage your capital and generate that monthly cash flow, more importantly, that passive cash flow if you're looking at rental properties. And then you can use it to limit or offset some of your tax bill by funneling expenses through your real estate business, things that you may not be able to expense from trading. It's a great way to add and build to your net worth. So I think all in all, trading, as I mentioned in the beginning, is a small part of the bigger picture. And when you really sit down and think about that bigger picture and begin to clarify the longer term goals, you can begin to really hone in on your trading goals, specifically what you would like to get out of trading, and you can begin to clarify the specific elements to your trading and how you're going to implement those and use those to develop longer term consistent income. Building that asset base, using trading to bring in or supplement an income, but then not just trading that money away, actually making those dollars that you generate work for you and leveraging those dollars to then pay you back over a lifetime. So I will leave it at that for today, and I'll archive the webinar in the member dashboard section. I hope everyone has a great week, and we will talk to you again on Monday. Thanks, and take care.